How is everyone doing? So this is the first of what we're going to have as a regular video blog that we put up on the website. And what this is going to be really informal. It's essentially going to be me with my iPhone. So production value may not be the best, but what we want to do is, if we've been getting a lot of questions on a specific issue, or if there's specifically something happening in the economy, in the world, that we think we should probably address, we're going to use this as a platform and a forum to do that. So this is the first one. Again, we're going to stumble through probably these initial ones before we get good at it. But I'm going to start with the inflation question. It's the number one question that we're getting right now from clients. We've had two pretty big inflation numbers that have popped up in both June and July. Price increases in excess of 5%. That's something we haven't seen in this country for decades. And so it is a pretty big deal. And so we are seeing some price inflation show up. Main reason for that, the main concern about that, is just the amount of money that the government has dumped into the system since the onset of the COVID pandemic. To give you an idea, if you create more dollars, those dollars become less. It's pretty simple math in that regard. And we've been in a situation here in the past year since COVID started. The number of dollars now that have been created by the Federal Reserve are up about 20% versus where they were pre-pandemic. And so this would lead people to think, okay, inflation is a real concern. Is it something that we've got to grapple with here in the future? And the answer is maybe, but it's not as cut and dry as people think. I really listen to the bond market. I think that bond traders tend to be some of the best at pricing risk out there in any financial market. And in the first quarter, it looked like we were going to see a little bit more inflation, perhaps a little bit faster than people had thought. I mean, we had our 10-year Treasury Treasury note went from being under 1% in terms of what the yield was to almost 2% in the first quarter. But then something interesting happened even before Delta variant came out and put into question how quickly this economic recovery was going to be. You all of a sudden started seeing yields falling again, and yields went down below 1.5%, then down to about 1.2%. So the bond market was pricing that we may not see inflation as quickly and as radically as a lot of people feared. And I think that there's some truth to that. I think that an issue that we have right now is that you may have a situation where the government becomes harder for them to stimulate demand in an economy that doesn't open up again as quickly as they're really trying to. And so we could get into this weird mode where we see certain products and things in the economy where prices are shooting up because there's still some big supply chain issues. I mean, we're still in a position where in China, for example, the third largest port in the entire world and the fourth largest port in the entire world in the last month or so, portions of those ports have closed up because they've had some new COVID outbreaks there. You've got obviously Delta variant around the world now, and this reopening that we've had in the economy has slowed down a little bit. That slackens some of the demand, but it also creates supply chain problems. So the areas, specifically the products and things where we've got these supply chain problems, prices are going up because people need the stuff and it's not being made or it's not being shipped. So you're seeing it in some really focused areas of the economy. But I'm not necessarily in the camp that thinks that we're going to see inflation roaring back across the board in every sector of the economy. The bond market right now, at least, is not saying that that's going to be the case. And also, we've got some other precedent around the world where governments can spend a lot of money and they can try to stimulate a lot of demand, and it doesn't necessarily show up in price inflation. Let's look at the EU, for example. Most of the countries in the European Union, they've got financial balance sheets worse than what we have in the United States. And yet many of those countries are still paying, inflation is less than it is here in the US. I mean, inflation across the Eurozone has been about 1.2% over the last 10 years versus about 2% for us. And they've been spending more money. And they've tried negative interest rates to stimulate that demand. I mean, Germany is a great example. You give the government of Germany your money for 10 years, they give you back less money in 10 years. You have negative interest rates, or at least in this country, as paltry as our interest rates are, you've got some positive interest rates. So, but you've got a case where they've spent more money, but inflation hasn't showed up. The biggest example, I think, is Japan. Japan, through the 70s and 80s, the economy was absolutely booming. They had 20% plus inflation in the 70s. And all of a sudden around 1989, 1990, the Japanese economy completely crashed. They had aging of the population. They had a number of things that were going on. But now for 30 years, the government has done everything they can to stimulate demand. They haven't been able to do it. So to give you an example, debt to GDP, which is how much debt does a government, does a country have relative to its economic production? Right now in the United States, we're about 130% debt to GDP. These are numbers we haven't seen since World War II. They're really high. But there's a number of countries in Europe that have higher debt to GDP. But then you look at Japan, and Japan was about 50% debt to GDP in 1990, and then they've gone on this massive spending spree to try to encourage inflation because they've been in a deflationary environment, a deflationary environment over there for the last several decades. They're now pushing 300% debt to GDP. They've got no inflation, and they've been unable to stimulate this demand. And so I think that is, just because the government's spending a lot of money and printing a lot of money, that doesn't mean that inflation follows. And the bond market, at least in the very near term, is saying that inflation across the entire economy may not happen as quickly as some people fear. So in any event, that's just kind of about 4 or 5 minutes about what our thoughts are on inflation. It's definitely something that we watch. We have a lot of bond positions, with our clients that we really care about what happens in terms of inflation. I agree it could be a concern at some point, but I don't believe it's going to get here as quickly and as fast as people fear. But I'm going to continue to look to the bond market and see how those securities are being priced to determine if I hold that opinion in another 2 or 3 weeks or so. So again, to sort of wrap up, I think it's definitely a concern, the amount of money that we're spending, the amount of money that's in the system. I do think there's going to be repercussions down the road, but I don't think it'll happen exactly in the way that people fear, which is widespread rampant inflation across the entire economy, at least not yet. Anyway, if this has been useful, please let us know. We'd love to talk about this stuff. If this has generated any questions in your own mind about some further clarification on anything, we'd love to definitely continue to have a conversation with you. Call myself, call any of the members of my team, because we love talking about this stuff all day long. And this is our first video blog. Hopefully our production value, I doubt it's going to get much better. It's going to be me with a phone. But at the same point, hopefully we'll continue to deliver some ideas and some thoughts that you all want to hear. But otherwise, if you watch this video and it's taken 7 minutes out of your life to hear what I have to say about inflation, I really appreciate that, and I look forward to talking to you all soon. Take care.